The adjusting process, part 2. In this lecture, we're going to discuss journal entries for accounts requiring adjustment and be a little more specific with the actual journal entries. Here is a depiction of an unadjusted trial balance from Net Solutions. This actually came from Chapter 2, and this should look familiar to you if you have been reading your book and studying your material. Again, a trial balance is just simply to prove that debit and credit balances for accounts are equal, and to make sure that all debit accounts are listed in the debit balances and the credit accounts are listed in the credit balances. This is a chart of accounts with an expansion based off of the adjusting entries. You see additional accounts added: accumulated depreciation for office equipment, wages payable, rent revenue, depreciation expense, and insurance expense. These accounts are actually associated with accounts that we've already used, and they're going to be used in the adjusting process. For example, depreciation expense and accumulated depreciation are used in the same adjusting entry. Accounts receivable, fees earned, is used in the same adjusting entry. Wages expense and wages payable is used in the same adjusting entry. Insurance expense and prepaid insurance is used in the same adjusting entry. Unearned rent and rent revenue is used in the same adjusting entry. So the ones highlighted in red are the ones that are being added due to the adjusting process. Let's take a look at some prepaid expenses. Net Solutions Supplies account has a balance of $2,000 on the unadjusted trial balance. Some of these supplies have been used. On December 31st, the account reveals that the amount of supplies on hand is $760. Based on this scenario, we started with $2,000 and we ended with $760. So we must determine what we actually used. So we take the beginning amount, subtract the ending amount, and we determine that $1,240 worth of supplies were used throughout the month or the period. So let's go ahead and journalize this. The adjusting entry to adjust the supplies account would be a debit to supplies expense for $1,240 and a credit to supplies for $1,240. Once this journal entry is posted to the ledgers, the supplies account will have a balance of $760. I want to go ahead and make a note here that the post reference here again in the journal is the account numbers associated with these accounts. Now, how did this have an impact on the accounting equation? Well, we decreased a asset and we increased an expense. Let's look at another prepaid. The debit balance of $2,400 in prepaid insurance account represents the December 1st prepayment of insurance for 12 months. So on December 1st, they made a $2,400 payment to pay 12 months worth of insurance. Let's adjust it. We will debit insurance expense for $200, credit prepaid insurance for $200. The effect on the accounting equation is an asset decreased and an expense increased. If we happen to omit this particular adjusting entry, expenses will be understated, net income is overstated, assets is overstated, and owner's equity is overstated. Basically stating that the company made more money than it really did. The assets on the books are going to be overstated, showing that we have more money in the prepaid account than we actually do. And then, of course, because this all ties into owner's equity will be overstated, and the owner will not have a good idea of what their leverage is in the company. Let's look at an example of prepaid expenses. The prepaid insurance account had a beginning balance of $6,400 and was debited for $3,600 of premiums paid during the year. Journalize the adjusting entry required at the end of the year, assuming the amount of unexpired insurance related to future periods is $3,250. You will debit insurance expense for $6,750, credit prepaid insurance for $6,750, and then you would post this journal entry to the ledgers. Let's take a look at unearned revenues. The credit balance of $360 in Net Solutions unearned rent account represents the receipt of 3 months' rent on December 1st for December, January, and February. At the end of December, we must adjust this account for 1 year, for 1 month, showing that we have earned rent for a month. We will debit the unearned rent account for $120, credit the rent revenue account for $120. That's $360 divided by 3 months, $120 a month. The effect on the accounting equation, we decreased the liability and we increased revenue. The impact of omitting this adjusting entry, revenues will be understated, net income will be understated, liabilities will be overstated, and the owner's equity account will be understated. An example of the adjusting of unearned revenues, the balance in an unearned fees account before adjustment at the end of the year is $44,900. Journalize the adjusting entry required in the amount of unearned fees at the end of the year is $22,300. You will debit unearned fees for $22,600 and credit fees earned for $22,600. And then you will post this journal entry. Net Solutions signed an agreement with Danker Company on December 15th to provide services that are rated $20 per hour. As of December 31st, Net Solutions had provided 25 hours of services. The revenue will be billed on January 15th. Let's go ahead and record some accrued revenues. We will debit the accounts receivable account for $500 and credit fees earned for $500. That's the 25 hours times $20, $500. Debit to accounts receivable, a credit to fees earned. The accounting equation is impacted by an asset, accounts receivable being increased, and revenues being increased. If we omit this adjusting entry, revenues will be understated, net income will be understated, assets will be understated, and owner's equity will be understated. An example of accrued revenues. At the end of the current year, $13,680 of fees had been earned but not yet billed to clients. We must journalize this adjusting entry to record the accrued fees. We will debit accounts receivable for $13,680 and credit fees earned for $13,680, and then we will post this journal entry. Accrued wages can be a little tricky. The one thing that you need to remember here is that pay periods sometimes split between months. For instance, we have a 2-week pay period where it's 2 days of the 2-week pay period happened in December and the remaining happened in January. When we close the books out at the end of the year, we must take the 2 days of the pay period and apply it to December, and then when the end of the pay period happens, we will take the remaining and apply it to January. So let's take a look at how this works. Net Solutions pays its employees biweekly. During December, Net Solutions paid wages of $950 on December 13th and $1,200 on December 27th. As of December 31st, Net Solutions owes $250 of wages to employees for Monday and Tuesday, December 30th and 31st. We'll debit wages expense for $250 and credit wages payable for $250. And we will leave both accounts the way they are until the end of the pay period. Now, the effect on the accounting equation for this journal entry is that a liability increased as well as an expense increased. When Net Solutions paid the wages of $1,275 on January 10th, this payment includes the $250 of accrued wages recorded on December 31st. Wages expense is debited for $1,025, wages payable is debited for $250, and cash is credited for $1,275. The impact of omitting this adjusting entry is that expenses will be understated, net income will be overstated, liabilities understated, and owner's equity will be overstated. Let's look at another example of accrued expenses. The San Reality Company pays weekly salaries of $12,500 on Friday for a 5-day work week ending on that day. Journal as a necessary adjusting entry at the end of the accounting period, assuming that the period ends on Thursday. We will debit salaries expense for $10,000 and credit salaries payable for $10,000. And then we will post this journal entry. Depreciation expense. Fixed assets or plant assets are physical resources that are owned and used by a business and are permanent or have a long life. As time passes, a fixed asset loses its ability to provide useful services. This decrease in usefulness is called depreciation. All fixed assets, except for land, lose their usefulness and thus are said to depreciate, except land. Land never depreciates. As a fixed asset depreciates, a portion of its cost should be recorded as an expense. This periodic expense is called depreciation expense. I also commonly refer to this as a systematic way of writing off the cost of a fixed asset over a period of time. The fixed asset account is not decreased when making the related adjusting entry. This is because both the original cost of a fixed asset and the depreciation recorded since its purchase are reported on the balance sheet. Instead, we will credit the account accumulated depreciation when doing the adjusting entry. So let me kind of clear this up a little. We will not go back to the original asset and affect that account. Once we record the fixed asset, we leave that account alone. When we record the depreciation, we will use depreciation expense and accumulated depreciation, but we will not go back to the original fixed asset. Accumulated depreciation accounts are called contra accounts or contra asset accounts. We call them contra accounts because they contradict the asset that they are attached to. The normal titles for fixed asset accounts and the related contra asset accounts are as follows. Land does not have a contra asset account because it is not depreciated. Building, store equipment, office equipment will all have a contra asset account, accumulated depreciation, building, store equipment, office equipment, respectively. Net Solutions estimates that depreciation on the office equipment to be $50 for the month of December. We will debit the depreciation expense account for $50 and credit accumulated depreciation office equipment for $50. And then we will post this journal entry. The effect on the accounting equation is that an asset is increased as well as an expense is increased. The difference between the original cost of the office equipment and the balance in the accumulated depreciation office equipment account is called the book value of the asset, or net book value. It is computed as shown below. The cost of the asset minus accumulated depreciation equals book value. Cost of office equipment minus accumulated depreciation office equipment equals the book value of the office equipment. The original cost was $1,800. The depreciation is $50. So the book value of the office equipment is $1,750. The impact of omitting this adjusting entry is expenses are understated, net income is overstated, assets are overstated, as well as the owner's equity is overstated. An example for depreciation. The estimated amount of depreciation on equipment for the current year is $4,250. We must journalize the adjusting entry to record depreciation. We need to debit the depreciation expense account by $4,250 and credit accumulated depreciation for equipment $4,250. And then we will post this journal entry.